For financial markets, the past few months have seen a dramatic increase in volatility. This should come as no surprise, given that a period of central bank policy divergence is approaching. In the next year or so, we should expect to see higher interest rates in both the US and UK, while Europe, Japan, China and others all ease monetary policy further. Although a solid economic performance for the US in the year ahead is still expected, the very low inflation outlook has altered my view on the bond market. While we still expect US bond yields to drift higher through 2016, this is now much more likely at the short end of the yield curve than the long end. The low inflation environment that is expected and the resultant very gradual policy normalisation process now likely from the Fed should hold no fear for the bond market. This would imply an increase in US 10-year bond yields from current levels near 2.1% to around 2.75% by the end of 2016. I would also expect the US yield curve to flatten. The positive US dollar theme for much of the past 2 years has been around the economic outperformance of the US economy and the expectation of US Fed rate hikes against the sub-trend economic outlook in Europe, Japan and China. Given our expectation that the Fed will still raise interest rates in December and continue through 2016, we would expect the US dollar rally to resume in the months ahead. However, the very gradual pace of this tightening cycle is likely to limit the upside for the US dollar from here. For the equity market, the recent increase in volatility is likely to remain a key feature going forward. But there are a number of factors that could prove supportive for US equities in the year ahead. The first is, we still expect a relatively solid performance for the US economy through 2016. Growth of around 2.5% for the year is not to be dismissed lightly. Secondly, this solid economic performance is not expected to lead to a rapid increase in either inflation or Fed monetary policy. The very gradual nature of the Fed's monetary policy normalisation process is unlikely to hold much fear for the equity market. In addition, it seems that we may not be too far away from maximum bearishness on the economic outlook for China and some key commodity and emerging markets, given that we are now seeing some policy response from these markets. Any stabilisation in the outlook for China and some of the other major economies should help the US equity market regain some of its lost ground.